Hello and welcome everyone. Today is December 31st, 2024, which means this is our last live stream of 2024. And I figured, why not do a case study? And let's end the year strong, refreshing your mind on frameworks. If you're already accustomed to this YouTube channel, we cover a lot of case studies on our personal finances. We dive deep into the numbers. We look at frameworks. We look at rules on how to operate our finances or how you can operate your finances, and that'll help you make the best decision for your finances, right? And then we incorporate strategies that you might be interested in, that maybe you came across the internet. You're like, how does this work? How does that work? What is this strategy? How does this strategy pair with this? And that's what we have been doing for the last 6 years on this YouTube channel. So if you're someone that's loyal, subscriber, client, friend, family member, this is going to be a very healthy refresher and also a reminder letting you, hey, maybe, you might have got a little lazy on this rule, or you might have been abusing this a little bit too much. Just letting you know, hey, let's evaluate where we're at, how we're doing. Is what you're doing mathematically making sense, or was that an emotional decision that's now biting you, right? Months later, is that decision now messing you up financially? Let's, dive deep into our principles and rules and how to proceed. If you're brand new to this YouTube channel, this can be very helpful for you, especially if you're brand new to velocity banking, you're brand new to infinite banking, you're brand new to non-traditional ways of handling your finances. What's beautiful is you're coming into it without having any necessarily bad habits, right? So you're catching a video that's going to dive into the rules, into the fundamentals and the frameworks on how you can operate. You choose whether you take this or not, right? What I have seen over the last 6 years, working with over 1,000 plus families, serving tens of thousands of people, hundreds of thousands of people on this YouTube channel. These rules, these principles simply don't lie to you. It's so awesome. Every case study, every situation, bad, good, in between, I don't know, crazy. It never matters what the person's situation is. I inject these principles, I inject these rules, these formulas, and it literally, it works out every single time. And even when it doesn't work out in terms of what they thought it should do, this is giving them, hey, conservatively, here's how you can proceed while mitigating risk, while understanding your leverage position, right? So sometimes it's not a matter of whether these rules will produce a particular result you're looking for, but rather it brings awareness to what you have been doing and how you can be more efficient. It reveals whether or not you are in a declining state, stagnant, going up, right? It's so revealing in good ways, and also warnings like, hey, stop, you're over leveraged. If you borrow from this line of credit, if you borrow from these 3 credit cards and pay your balance transfer fees and go try and buy that property and fix and flip it, you are creating 7 more risk that you're unaware of because you don't know what your cost of money is. You don't know what it is to be over leveraged, right? It's very rare when you step into this world of non-traditional finance where the guru like myself, the content creator, the educator, is pro-debt, meaning they like to use debt to make money. They like to use debt to pay off debts. They understand acceleration. They understand how to offset. What is often not talked about is, well, how much debt should I leverage? Is there a number in mind? Like, is there a standard, a framework? That I've never seen that displayed. And on this YouTube channel the last 6 years, it's been my goal to develop that framework. right? And I would say that now I have it down to a science. It's been proven to work over numerous case studies, scenarios, financial situations, circumstances. And I will still let you know that this is still technically all theory, right? It's theory based still, because I personally like to see multiple decades of a result when it comes to finances, some things I can rely on. And obviously, the longer you have in history, the more financial scenarios you can rely on, right? To say, yeah, this makes total sense, right? This is validated. This works in high interest rate environments, low interest rate environments. This works in a recession. This works in a depression. This works in, a real estate market crash, right? A stock market crash. These things still work. So what I'm letting you know is that this framework that I have, these rules and principles, these foundations, are 6 years of history. It's not a lot of history, right? When you compare to whole life insurance strategies that I teach on this YouTube channel, there's over 200 years of history when it comes to a properly structured whole life insurance contract. You've got 200 years of history there, practically, right? You've got companies that have been in business for over 150 plus years, right? That have provided consistent results, that provide levels of guarantees, okay? So what I'm not saying is that these rules that I have, these principles, are quote unquote guaranteed to work every single time. It really depends on like what is the result we're trying to look for, right? I would say these rules and fundamentals reveal where have you been, how you're operating, and if you choose to do this strategy called velocity banking, called infinite banking, that if you do it this way, you're doing it conservatively, keeping in mind that life happens, life events, unexpected expenses, risk, right? And when those things happen, your ability to overcome those challenges and obstacles are more likely, like I would say over 75%, 80, even 90 plus percent, the financial effect, the financial impact of that crisis, of that unexpected circumstance, you'll be able to compensate. You'll be able to make tweaks. You'll have flexibility. You'll have room for error so that you can continue to proceed and actually hit your goals right on time, ahead of schedule, right? And if there were slight delays, there's not a huge downtime of you trying to like almost refigure your whole financial strategy, okay? So that's giving you the full framework here. I'm now going to dive into velocity banking and infinite banking framework to invest, right? And also to pay off debt. On the board is going to be to pay off debt. I'm going to share my screen and just show you my framework on how these questions, these standards, before we even start the strategy, what I'd like to have in place, and your knowledge and experience with these particular strategies. So let me go ahead and share my screen first, give you that framework. By the way, if you want any of this material that I have on these Word docs, you just email me directly, okay, and ask for it. I simply provide that. That's like a totally free resource, and you can obviously cater it to your own standards, or if there's something that maybe I might have missed in here, right, that you can use for yourself, okay? So let's zoom in a little bit. All right, you should be able to see that nice and clearly. So before we even get into the strategy of velocity banking and infinite banking combined, whether it's to invest or pay off debts, or do both over a period of time, I would like you to have these things already in place or the tools ready to go. Okay. So 3 to 6 months worth of expenses that according to your lifestyle. And when I say expenses, I mean everything. Okay. How much you tithe, how much you save, how much you invest, all your costs of living to operate, all your debt payments, preferably. Okay. 3 to 6 months worth as your emergency fund that's liquid and available to you. Right. Enough capital to max fund the life insurance policy or policies in the first year up front. That is very, very healthy, where if you have a certain goal in mind in terms of the amount of money you're wanting to fund into a life insurance policy, that you at least have first year's funding all up front ready to go deposit into that policy, because it's going to give you that much more financial security rather than setting a standard hoping you'll get to it over a year's time frame, and then you don't do it, and then that creates an inefficiency in the policy design itself. So instead of funding it monthly or quarterly, annual, semi-annual, or sporadic, and not hitting that number that you decided with your insurance agent, that it could create an inefficiency, especially if you're leveraging to fund the policy in the first place. Okay, so enough capital upfront to max fund the policy each year. I would like to see positive cash flow, $1,500 or more, conservative and consistent per month, at least 90 plus days straight. Where it's like, hey, very safely, Denzel, if I'm not working overtime, if I don't get commissions, like I'm consistently bringing in at least $1,500 net after tax, cash flow, money that doesn't have a purpose, that's just liquid and available to me, conservatively. Right? Next is a secure stream of income, your career, your business, a steady job. Okay, if you've only been working your job for a year, right, but it's a dead end job, or if you go from dead end job to dead end job, like there's no opportunity for advancement, career advancement, personal development. Okay, that's something to keep in mind, right? Again, these are standards that I have for myself, where I believe I can't go wrong if I have all these things. If you have 3 out of the 8 things here, right? If you have 2 out of the 8 things here, like understand that if you try to move forward with this strategy, you're probably going to hurt yourself in the long run, right? So again, it's just awareness. It's like, okay, Denzel, I got 3 to 6 months worth of expenses. I have enough capital to max fund my first policy for the first year up front. I have $1,500 a month in cash flow. I have a secure career that I've been working in for 5+ years. I have a line of credit available, second position HELOC. I've got a credit card that I use to run bills. I'm pretty much debt free, or everything is paid off except for my mortgage and student loans, right? And I have really good financial stewardship, because prior to finding you, Denzel, I was listening to Dave Ramsey. I was doing the baby steps. I spend less than what I make. I don't try to keep up with the Joneses, right? I have good stewardship, right? You have a history of saving, of displaying good financial stewardship. These are all wonderful things to have in place before you implement the strategy, right? Because the strategy is wonderful and awesome. Yes, no doubt. That's the sexy part of finance, is like strategy. The boring stuff, the mundane, are the fundamentals that don't necessarily show you how to make $1 million, become a millionaire overnight, right? But those fundamentals and principles keep you from losing your millions, right? Or whatever wealth you do have, okay? So to recap, 3 to 6 months worth of expenses, enough capital to max fund your policy. 3, positive cash flow, $1,500 or more, conservative and consistent. 4, secure stream of income, career, business, steady job. 5, an active line of credit, personal line of credit, business line of credit, home equity line of credit, first or second position. A credit card. 6, for running expenses through the card, or multiple credit cards. You get to choose based on your capacity to manage that. I'd like you to be debt-free, or everything is paid off except for, let's say, mortgage and student loans, because those tend to be very low in terms of sometimes your what do I want to say here? Like when it comes to consumer debts, when it comes to utilization debt, car debts, those often are very attractive from a cash flow perspective and don't take as much time compared to trying to pay off a mortgage or a student loan. The amount of time it takes to pay that off, although there's a large cash flow gain and large interest savings by accelerating it, okay, no doubt there. But when we're talking about combining velocity and infinite banking together to remove, let's say, the mortgage or student loans, right? You're holding on to that debt for now. You're okay with the cost of money to carry that because of the strategy you're going to put in place and ultimately the final result that you're going to have. Once you are completely debt-free, you're not just debt-free and broke, debt-free with no asset. You're debt-free plus you have an asset that's growing, okay? And then lastly, good financial stewardship and cash flow management. So that's 1, 2, 3, 4, 5, 6, 7, 8 things. 8 solid things for a proper velocity banking and infinite banking framework, okay? The next thing I want to share with you is the financial decision-making process when you are evaluating these different strategies. So I'm the type of person that comes on social media as an influencer, as an educator or guru, whatever it is you want to call me, financial coach, and I'm talking about strategies that I practice myself and with my clients, right? Things that I believe in, things that I do, things that I'm convicted in. And yet, I will still challenge the very thing that I'm talking about as if I'm against it, right? As if I'm like, be paranoid, be skeptical. Like, I'm okay with you being skeptical about me. I'm okay with you doing your due diligence on me, Googling my name, researching the history of these strategies. Like, I'm all for that. I'm for challenge. I'm for dialogue, conversation, right? I bring people on this channel from time to time that don't necessarily agree with 100% of what I'm saying or believe fully that velocity banking and infinite banking are scams. And I'll bring them in and share their points, and I share mine, and that helps you make the best decision for your finances. So I'm that kind of person that's not just giving you all the wonderful things about these strategies, but also giving you the negatives, the cons, and things to be aware of. This financial decision-making process that I've come up with for myself and my clients, also another great foundation as to whether or not you should proceed with this, even if it's a good strategy. Is it good for you, right, is the key here, because we're dealing with personal finance. This is your personal finances, right? So these are 6 points for you to keep in mind when you run the strategy, okay? So before you even get the strategy going, think of it as like, okay, this is your first time watching my channel. Let's just say you're brand new. Comment below if you're brand new, first live stream, or you just found me within like a few months, okay? Comment below. Let me know if you're here and present. So let's say you got this and you find me. So number 1 is me presenting the opportunity. So have the opportunity presented to me from the giver. I'm the giver, you're the prospect, you're the potential client in this strategy. So you're giving me the opportunity to present to you, a professional, okay? Then number 2 is you would review this opportunity with a professional to confide in. So let's say, again, I'm the presenter presenting to you velocity banking and infinite banking. The next best thing that you could do after watching this full video, this full masterclass, is you either reach out to another professional that you trust in, that you can confide in, and send this video to them and see from their perspective, hey, he missed this. Hey, he didn't say this. Hey, he left this part out, right? Then, this is super important. Review the opportunity with your spouse. Oh my goodness. I am now a married man, okay, in case you didn't know. My last live stream, I let y'all know that the next time I go live, I'll be a married man. So December 27th, went to the courthouse, sealed the deal. Okay. What I have learned as a young millennial, 28 years old, about to be 29, January 4th, in case you want to get me anything, that, and my 6 years of coaching husbands and wives, families, is that when there's miscommunication between spouses on the finances, oh my goodness, what a headache that is. Okay? When husband doesn't share with wife that he just hired this 28-year-old kid on the internet and joined his lifetime program and spent $4,000 and then has been, working with him for a year and a half, and then wife is on a completely different trajectory, right? I simply don't do that no more, right? That came with hindsight. I did not know how important it is to discuss financial strategies and decisions, even if the spouse doesn't make any of the money, even if, or makes less money. Like, my most successful clients always are better when wife is informed, or vice versa, when husband is at least informed of who Denzel Rodriguez is. At least show him a video, right? Say, hey, this is the person I decided to, bring into our family, bring into our household to help us with our finances to achieve financial freedom and independence and become debt free. Very important, okay? So that's number 3. Review this opportunity with your spouse before you proceed, is my recommendation for someone who's been married for 4 days, less than 4 days, okay? Number 4, research said opportunity in detail, looking for data, facts, history, credibility, reputation, authenticity. Now, the downside of researching velocity banking and infinite banking combined is, unfortunately, you're not going to find much data. You're not going to find much facts. You're not going to find much history. You're not going to find much credibility. You're not going to find a whole lot of reputation. You're not going to find a whole lot of, you are going to get a whole lot of authenticity, because that's me authentically presenting to you. So authenticity is more of a character, right? A matter of character. Reputation as well is a matter of character. But when it comes to credibility, 28 years old, I started talking about velocity banking and infinite banking combined when I was like 23, 24, right? Again, I haven't seen anybody on the internet do this at scale where they have multiple case studies. I've only seen it on this channel. Those two strategies coming together and detailing every single number in that situation, in that strategy. When it comes to history, only 6 years. The facts are the facts that I'm presenting to you in this video and other videos I've done. When looking for data, what you are going to find is you're going to find other velocity banking videos, and you're going to find other infinite banking videos. Those strategies by itself has tremendous amount of history, data, facts, credibility, reputation, and authenticity. Plenty, right? But bringing them together, very tough, because you have infinite banking practitioners that a majority of them don't agree with velocity banking. It's as if they see it as a competition. And then velocity banking, oftentimes, they don't even know what infinite banking is, or they don't teach a whole lot on it. And if they do, it's just like it's another topic for someone else to discuss. They kind of stay over here in their lane, which makes sense, right? What I've done is bring those two together. I say, hey, I'm just kind of looking at these two things, and I'm like, this could go really well with this. If I could plug it in together, it could create like a chain reaction for my finances and just create this money making machine, this money efficiency machine that could just be like a, a velocity flow, an infinite velocity flow. Amazing, right? So that's where I bring those two together, right? Now, the next thing on here, right? So we got, researching the opportunity that I just presented. Now you run the numbers and you do a worst case scenario, a mid, and a best case, right? Best case is obviously like nothing goes wrong, right? Nobody dies in the family, no one gets sick type thing. Then you do a mid, like you just run the scenario but just lower the results and then say, okay, are you okay with that? And then you do a worst case scenario with any strategy. If it's an investment strategy, a real estate strategy, a trading option strategy, like what is the worst case scenario if I engage in this investment? Worst case is you lose all the money you put in. That's typically the worst case. You lost all the money that you put in. So therefore, will I be okay financially if I lose all this money that I'm going to inject into this strategy? The same with velocity banking, infinite banking. What happens if I just decide to just not listen to anything Denzel says and try to do it my own way? What could happen, right? So you do a worst case, mid, and best case. Finally, you present all data. Number 6 is for people of faith. People who have strong convictions in their faith, right? You present all this data, strategy, and plan to the Father for a final review, for God the Creator, and you wait for confirmation to proceed. Okay, that is a kingdom protocol, number 6. Okay, and then what's nice is setting the intent, the goals in mind. So it's nice to have what's called a financial independence number and a financial freedom number. What I'm sharing with you are my personal financial independence number and my financial freedom number. Okay? So the way you discover your financial independence number is based off of your current cost of living today, right? And you can add whatever debts you have as well. So we're going to take it to the whiteboard, and I'm just going to give you an idea of what financial independence would look like for this person here, right? So financial independence technically is you have enough income coming in passively to provide all your needs according to your lifestyle, according to how you live. So if your lifestyle is $20,000 a month, $10,000 a month, $5,000 a month, whatever it is, if you can have that produced in the form of passive, preferably guaranteed income, guaranteed or passive income, a little bit of both, then you are financially independent. Financial freedom is like you're able to do whatever you want with whomever you want, whenever you want, go where you want. You have ultimate freedom of time, right? No worry whatsoever. You have an abundant amount of money and wealth that you don't need, and you are like in a contributor position, you're in a philanthropic position. You are able to just do things at your own will according to your rule in your household, right? So let's take a look at the board here now. We have a case study here, right? Example, person making $17,000 a month. Expenses are $13,030.58. For this person to be financially independent, they need to be bringing in passive income. This is all active income, $17,000 a month. If they produced over $13,000 a month in passive income net after tax, then they would have achieved financial independence, meaning they actually don't have to go to work to make money. Whatever they actively produce above their independence number is bringing them closer and closer to financial freedom. right? So on the board, we're dealing with a husband and wife. This is a client. I'm working with the husband directly. Wife is informed of what's going on, okay? She's aware of who Denzel is. That's important, right? That's good. $17,000 a month is husband's income. Wife does not work. Wife is stay-at-home mom, 2 kids, 2.5-year-old, 7-month-year-old. Okay. The husband is 44. Wife is 40. Okay. Husband has a desire to invest in real estate. So we know where we want to go as it relates to the income and how he wants to be able to produce that income over time. He wants to do it through real estate, which means any other income producing opportunity, although could be attractive and extremely lucrative, would be a distraction for this person. Do you agree? Comment below. Do you agree with that statement? If you have a desire, a passion for something specific, real estate, let's say, you want to become a master in real estate investing. You want to do it a particular way. But then I or someone on the internet presents trading options for you. Cryptocurrency, Forex trading, e-commerce, right? Amazon stores, Etsy stores, Shopify, becoming an influencer content creator, becoming what else is like, couch flipping. What is out there? What else? What are some pretty cool things out there you can make a ton of money with? Like just like flipping cars, let's say. Government contracting, right? Getting government deals and funding big projects and making millions of dollars. Like all of that, although amazing and lucrative and awesome, AI, tech, right, would be an ultimate distraction for that person. Would you agree with that? I say yes. So what that does, when you know where you want to go and why, we're able to eliminate all these different distractions. Literally, I'll have my clients, I'm like, look, when it comes to your social media feeds, unfollow these people, right? Unfollow these gurus, YouTube channel, like unsubscribe from all this noise. Cater your feed to just following real estate gurus. And then you cater it even more where you narrow it down to like 1 to 3 people that you listen to consistently, what they produce. I follow that all the way through. I'm going to see this one strategy all the way through before I inject another. Super important stuff here. Hope you're getting a lot of value from it. So $17,000 a month. Person is a anesthesia assistant. That's how they make their money currently today. So they have, let's go through the parameters, right? Let's literally look at the different parameters for velocity banking, infinite banking framework. This person has 3 to 6 months of expenses, emergency fund. This person has enough capital to max fund a policy or policies according to how we design it. This person has positive cash flow, 1,500 or more. This person has consistent, secure stream of income. They have a career. They've been doing this for 12 years, okay? They have an active home equity line of credit in the second position, okay? They have the ability to run bills through a credit card for expenses, get cash back or points. They are not debt-free, and they do not have everything paid off. That's the one thing that they're missing. And they do have good financial stewardship and cash flow management. They have 7 out of 8 parameters according to Denzel's framework for velocity banking, infinite banking. That gives me the confidence to proceed as your coach and accountability partner, right? That gives me the confidence to proceed and teach more and educate and encourage them to move forward with this particular strategy. Okay, 7 out of 8. We know where we want to go, real estate. That's what they want to invest in. So that means velocity banking, infinite banking strategy is going to direct result toward real estate investing. It's going to create the opportunity, the capacity, the leverage for them to do real estate. Anything other than that, the strategy is going to look off, right? It's not going to accommodate because we didn't plan it that way, right? So here's how we're going to now prepare for velocity banking and infinite banking. We need to know our numbers. As you can see, we displayed that. You need to have your debt tool. We need to see all your debts lined up. You can do it just like this. So we got 2 credit cards. Here are the balances owed. Here are the monthly payments. Here are the interest rates, as you can see. We have a lump sum of capital coming in, a $24,000 tax refund. They owe $12,500 as well in taxes, part of their debts. We have a student loan payment, we have mortgages, we have 2 vehicles, okay? As of right now, it's December 31st, 2024. Started working with the client December 13th, 2024. Very recent. So we don't have policies put in place. We're in the process of designing that and building that out. In the meantime, we're able to activate velocity banking right away. So we're going to look at our velocity banking and infinite banking rules of leverage. There's a video I did on my YouTube channel called Velocity Banking Rule of Leverage. That is one of my most favorite videos on velocity banking. Highly encourage you go look at that after you go through this entire masterclass. It's going to literally build upon what we're doing here. It's going to be really awesome for you. So, critical rule of leverage and chunking as it relates to velocity banking. You take your cash flow, conservative in a month, times it by 12. If we do it according to this person's number, you get $47,633.04. Take that number, times it by 2/3, is $31,437.80. And then you take the credit limit of the main debt tool that we're going to use for velocity banking. They have $61,000 credit limit. Times it by 66%, $40,260. We now have what's called our chunk range. A lot of people, I think, misinterpret what chunk means sometimes when they listen to other folks. I've always been pretty straightforward with it. Chunk, in other words, means lump sum. It's a lump sum of money that you're extracting, that you're withdrawing out of your debt tool, out of your line of credit to go do something with it. And you're only going to do 2 things. You're going to use that money to make more money. You're going to use that money to pay off debt. Essentially consolidate. Velocity banking is a more efficient way to consolidate debt. More often than not, it outperforms any traditional debt consolidation method. Because all we're doing in velocity banking is reducing cost of money. This is a key ingredient here. That's really what velocity banking boils down to. Reducing your cost of money daily. If we were to look at this person's cost of money today, right? You just look at how much interest they're paying on all their debts. And then we can calculate, here's how much your cost of money is to carry these debts per day. So by knowing where you are and then looking at what velocity banking has the potential to do, all we're trying to do is reduce cost of money daily, which means an increased amount of cash flow faster than if you were to just make extra payments toward your debt, right? It's very hard to argue when you can literally bring both of those concepts together. And that's what I've done over the years in my maturity as a young man, but also as a business owner and content creator, is I no longer argue why velocity banking is better than this. I simply say, why not combine it? Why not combine the philosophies of making extra payments with velocity banking? They don't have to compete. They actually can come together in a very cohesive synchronization kind of way. It's pretty awesome when you think of it that way. Okay, so that's our chunk range. Cash flow times 12 times 66%, credit limit times 66%, 40,000. Why do I do that? So the history behind this, just so you know, I had a mathematician reach out to me when I first started my YouTube channel. And he basically gave me that number, 2/3, right? And it accounted for so many other risk formulas that can come into play. So by you leveraging no more than 66% of your line of credit in any given scenario, you're creating a 33, 34% gap, right? For you to account for unexpected life circumstances, unexpected expenses, roof repair, home repairs, crisis, medical bills, you name it, things that pop up when life happens. You still have plenty of space. The person that maxes out their line of credit, tries to consolidate a bunch of debt into their line of credit, now they have this variable debt, they're exposing themselves to risks that they're just not even aware of, right? So that's why that I come up with that number and how I came up with that number. That was given to me. And I used it, tested it, experimented it. It's never failed me. That's what's so awesome about it. It's never failed me, right? It's never failed my clients. What fails is when they abuse it, right? They have, let's say they have 3 home equity line of credit and they use 66, 66, 66. I'm like, dude, like, no, you literally like try to manipulate the rule and all you did was put yourself in a worse position, right? So moving right along, you got a credit card combination with velocity banking. Being able to have a 0% credit card on standby that is anywhere from 12 to 24 months where you can float bills or consolidate more debt inside of it, still using the same 66% rule, right? So this is now looking at 2 credit lines. You've got your main debt tool, home equity line of credit in this example, and then we have a credit card of which we can decide, do we want to float bills? Meaning, we're going to look at expenses that we can pay on an annual basis. So we're not putting in new expenses in there. We're not increasing our cost of living. Everything that we're doing is supposed to reduce cost of living, cost of money daily. If you go against that, you're just hurting yourself in the long run. You're creating an illusion that you're doing something, but you're really not. And then you'll feel it a year later, right? That is one of the effects, the cons of when you do this strategy, is these just not having the awareness of what can potentially happen. Not understanding the fundamentals. Super important. So credit card, 0% on balance transfers and purchases, preferably, with 0 balance transfer fee. If you find that, it's even better. 12 to 24 months. Let's say your chunk was 30K on a vehicle, and the vehicle was 45,000, right? So you did 30, it brought it down to 15, and let's say you did another 10,000 on the card. There's only 5K left on the car. You put 10K on the credit card, and you're just simply paying the monthly minimum payment on that 0% card, and then doing velocity banking on the main tool itself. That could be one option. Another is you just figure out these consistent bills that you have where you're temporarily increasing cash flow so that you pay off your line of credit faster. So you could float, say, $10,000 worth of bills on the card. It increases your cash flow because you paid those bills, so now you don't have a monthly expense. You reduce your expenses temporarily, pay the monthly minimum payment, 0%. Doesn't cost you anything to carry that debt. And then you drive the rest of that increased cash flow toward the line of credit. The goal is reduce cost of money, reduce cost of living, right? So that's one credit card for that. Second credit card could be used for cashback or points to reduce cost of living. That does not mean I go get this credit card that has this bonus so that I can, basically reduce my vacation costs over here. But instead of you normally booking hotels that are 3-star, you go to the 5-star hotel resort because you have points plus your existing budget for vacation. That would be the incorrect way of doing this. What I would rather see you do is, okay, I know you already go on X amount of vacations per year, birthday, holidays, whatever it may be. And you typically go here and you typically stay at these kinds of hotels, right? 3 stars, 3.5, 4 stars, not 5-star. So if your vacation budget is X, $5,000 a year, and by using cashback and points, it reduced it to $4,000, that's better. Rather than you saying, oh, I already have a $5,000 budget and Denzel, I could get this $7,500 worth of value. No, you didn't do anything. You didn't do anything, right? You increased your cost of living because when you're there, you're going to spend more money because now you're at a 5-star resort. Now they have all these other fees that come with staying there, okay? Higher parking fees rather than no parking fee at this particular hotel, let's just say, right? So you're too many of you do that, right? Not fun. When you're in debt and when you're trying to remove and reduce to increase cash flow and efficiency, why inject more risk when you can simply remove it almost completely? Okay, so second credit card for cashback or points. More often than not, when you go with cashback rewards when you're in debt, I think it's more advantageous for you because you see the cashback right there and you apply it to the credit card statement balance. It reduces what you have to pull out of the HELOC to pay the bill. That means your cost of money reduced even more per day. It's right there, right? That is low-hanging fruit. Then lastly is when you do have a policy in place, I only borrow 66% max, right? Again, another leverage limit rule. The remaining is your emergency. So you have emergency on top of emergency. You have emergency in the HELOC and you have emergency in your policy. So what we're basically doing is we're creating money outside of the strategy to protect the strategy. And again, this is conservative. Some of you may not do that and still get, say, better results or good results. That's fine. You just did it with more risk. Okay? As long as you're willing to do that, okay. I'm not going to hold you against it. I'm showing you what I do. When you see every one of my YouTube videos and my case studies, they're always like reducing the power of velocity banking. It's always minimizing the results, right? On purpose, right? So it's like, hey, if this makes sense conservatively and beats traditional way of getting out of debt, just imagine when you're going full gear, it's going to go even better, right? Is what I tell my clients, and that gives them a bigger boost and they just get better results. It's awesome, okay? So now, gave you the rules, frameworks, context, what we're dealing with. Now we actually get into the numbers of it, right? And let's look at this thoroughly. We're going to start off doing velocity banking. We just got a home equity line of credit at 6.25%, 12 months intro rate. And then afterwards, I believe it goes to prime, right? The bank is in Texas. So any of you that are in Texas is a potential bank that you can look like. I'm not saying that's the bank you should go with. I'm simply saying in this scenario, in this context with the homework and all the pregame work that we did, we found this bank in Texas called WellBe Financial Credit Union, if I'm not mistaken. Let me look that up. Let me just verify for you. Yeah, it's called WellBe, right? So this is the bank that we're looking at, WellBe Financial. They have a home equity line of credit offer, 6.25% for the first 12 months, okay? And then that is on second lien. And then the rate goes to, I believe, 8% afterwards, which is sounds like a 0.25% below prime, if I'm not mistaken, or right at prime. Okay? So you can look that up if you live in Texas, and that could be a potential debt tool that you can use. So now we have our parameters, our chunk range. Now we look at the debts and see, okay, what could we eliminate, right? There is one more formula that has been super helpful this year and last year called cash flow index. I discovered cash flow index formula from Garrett Gunderson. He was the first person I heard speak about it. I started injecting it into my velocity banking strategies, and it's been perfect way for my clients to figure out what debts they should go after before talking to me and while talking to me, and even non-clients. So cash flow index is simply taking the balance owed on a debt, $1,397, dividing it by the monthly payment, $178.80, and you get a cash flow index number, right? That's 7.81 on that one. If the number is below 50, that's an attractive debt to pay off from a cash flow perspective. Cash flow index focuses on cash flow. If I can increase more cash flow, whoever has more cash flow wins in their speed of eliminating debt, right? If you do the next one, 5,000 divided by 459, got a 10.8. And then obviously, you keep going down the list, right? And you get all your cash flow numbers. So now here's the thing. This person wants to do infinite banking. Infinite banking does take some time to put in place, right? Meaning you have to qualify for it, right? You have to go through underwriting. We have to figure out the funding amounts that we would like to go with to proceed. So when you're doing velocity banking and infinite banking combined together, the speed at which it takes you to get out of debt will be slower because you're buying an asset called whole life insurance, and it has costs associated with that. So it's going to slow down your ability to get out of debt, okay? Before I go any further, can I just get a thumbs up, thumbs down on my audio and quality and visual? Just want to make sure. I saw someone comment choppy feed. Only had one hiccup on the feed personally. Okay. Cameron lives in Texas but don't have a home for HELOC, working on a PLOC. Cool. Thanks for the update on that. Let's see. Make sure. It'll go out and come back in. Well, that's not fun. Well, let's see why is that? Anthony says thumbs up. Okay. So it's like for some, and then for others, maybe not. So definitely most likely on the replay, we should be okay. But maybe it's just either certain people's Wi-Fi's, could be potentially mine, but according to what I'm seeing here, all my audio levels are good and solid. So I'm going to keep going, right? Coming back, getting into the actual implementation of these two strategies. We're going to start off doing velocity banking first, right? That's what we're going to do. We're going to start off doing velocity banking first, and then we're going to build out the infinite banking play. So they already know that they're going to go a little bit slower once they fully inject velocity banking, infinite banking together. They're okay with going a little bit slower because they're obtaining an asset, and that asset's going to grow over time. So when they are eventually debt-free, they'll be debt-free and they'll have this producing asset working very well for them, right? So that's going to be very, very powerful. Just keep that in mind, that velocity banking, infinite banking combined is not fully about speed. It's about efficiency and also wealth building while getting out of debt. How you can conservatively, safely get out of debt, and also convert your debt into wealth. So on the IBC side of things, for a policy, what we're looking at right now, using the same leveraging rules on cash flow times 12 and being conservative, what we're looking at is two policies, one on wife, one on husband. We're going to put more on husband because he's the breadwinner. So we're going to have more of a death benefit on him. What we're looking at is $25,000 a year on him, $5,000 a year on wife. Okay, that's what we're currently looking at. The other comparison that I did was 15K and 15K, so like a half-half split. But I informed the client, I said, if you were to do that, you put 15K on you and 15K on wife, and let's say we got approval and whatnot, the risk here is that if something happens to you, husband, all of your income is gone. And now wife would have to rely on that death benefit. I don't know if that death benefit at $15,000 a year is going to comfortably protect your wife in the event you pass away. So from a risk standpoint, I made the suggestion as an insurance advisor that we should put more money on you because you're more of a financial burden than wife is, right? If wife was to pass away, income doesn't go down necessarily, but the time that you would now have to put to replace what wife was doing at home would be a result of a decrease in income. And so that impact would be less of a financial impact than the reverse. Wife not working at all, no income coming in, would be detrimental to wife. You're bringing in $17,000 a month, right? Net after tax. We want to be able to replace that income for at least a good 3 to 5 plus years, or basically however long we can go without compromising the infinite banking strategy itself. Because if you focus too much on death benefit, well, we're not going to have so much cash value available to us. So again, these are weighing the different risk when doing the strategy. So keeping that in mind, the way I'm designing these policies, 25K and 5K, is max cash value, minimum death benefit, right? So what could be done over time is we could get another life insurance policy on husband that's simply term insurance, very cheap, just to have that extra death benefit protection without compromising the strategy, without taking away too much cash flow. Okay? Very, very important. So that's what we're looking at, husband and wife, 30K a year. Where'd I get the 30K? Look, cash flow times 12 times 2/3, boom, 31,437. I rounded down. Whatever the number typically is of your cash flow times 12 times 66%, I just take the lower number. Right? So it's like I'm adding more and more barriers and protections on this. So that means 30,000 out of their 47,600 cash flow is going to an asset. And then of that 30 grand, we're only going to use 66% of the available cash value. So let's take an estimation. Let's just guess here that out of $30,000 going into life insurance, let's just say total cost is about 15%. Meaning their total cost of insurance is about 15% of what they're putting in, right? So you minus $4,500 from 30,000. So we'll have about $25,500 $500 in cash value. Let's just say that was the number. Then you take that number and minus 90% from it. Okay? I'm sorry. Don't do that. 25,000 times 90% is 22,950. When you fund a whole life insurance contract in the first year and onward, depending on the company, you can typically borrow up to about 90% of the available cash value. So if that's the case, I can only borrow out a max of 22,950. So following this rule here now, if you took 66% of 22,950, let's do that. What's that number? So 66% of that number. So we're really only going to borrow, and I again will round down, we're only going to borrow about 15 grand out of this policy, right? So that means in regards to debt elimination, there's 15,000 at play to go towards debt elimination, debt pay down, and then the difference between 47,633.04 and 30,000 is another 17,633.04. So now what we're really talking about is only about $32,633.04 is being applied toward the Velocity banking strategy to eliminate debt. So again, this person's goal, long term, they want to be able to invest in real estate, replace their income. That's going to happen over a long period of time, or it could happen in a short period of time. While that's going on, because they're not distracting themselves with any other income opportunities, the biggest bang for their buck is to simply eliminate these debt payments, these different debt payments. There's so much cash flow here to be recovered on a guaranteed basis. Does that make sense? Comment below if that's clear so far. So from the funding strategy of life insurance, we got 30K. And then of that, only going to use about 15 if we follow these rules. For a total at play of 32,633.04. Looking at my home equity line of credit, looking at my chunk amount, we have to keep in mind that the chunk has to also account for how much money we're funding the policy with. So what you don't want to do is chunk, let's say, $31,437.80 from your HELOC and then have to borrow another 30 to fund your policy. You don't want to do that. That's not going to make sense. So if there's 30 grand going to be coming out of the home equity line of credit, because it's Velocity Banking, Infinite Banking framework, so we're using Velocity Banking to max fund the life insurance policy. What's at play here? We have a $24,000 refund to keep in mind that's coming in the new year. What we could do is we could earmark that money simply for funding and then only borrow 6 grand out of the policy, right? We could literally do something like that. And I honestly like that more. So I'm going to illustrate that, where we're only taking 6K from HELOC to fund policy. That's it. Then we look at the debts that we could eliminate, right? Let's say we just did $1,397 and $5,000. $1,397, $5,000. So that's $6,397. Keep in mind, we got about maybe 2 to 3 months before we actually put the policy in place. So we could do a little bit of velocity banking to start the process, get the rhythm going, start getting some wins, start recovering new cash flow. When you recover new cash flow, it increases your leverage capacity. Understand that as well. Okay. So we got 6,000 that's earmarked for leverage. That technically isn't coming out right away. And then we got 6,397 that's going to pay off 2 debts. Guaranteed cash flow 459 and 178.80. Okay. Then we've got these 2 cars. Let's see from a cash flow index perspective, which car makes more sense to pay off first? The lower balance one? If you were doing debt snowball, it would be the lower balance one. If you were doing debt avalanche, it would be the higher balance one because it's higher interest rate. What does cash flow index say? 18,951.70 divided by 352.47. So that got a 53.76. 22,852.53 divided by 441 and 88 cents. That got a 51. So, according to cash flow index, we should be paying off the higher balance vehicle over the lower balance vehicle. Okay? That's what cash flow index says. That snowball says go for the lower balance. That avalanche says go for the higher balance. If we're looking at cost of money daily, you can make a strong mathematical argument that paying the higher balance car off first makes more sense logically. If the client wants to intercede and say, Denzel, from an emotional standpoint, I feel more confident knocking off the lower balance, then I will yield to what that client says personally. Why? Although math says go after the higher debt balance, there is this variable of the human factor. If the client is confident, that gives me confidence that I think we can actually outperform what math says from an emotional standpoint, from a performance standpoint. You might get a higher increase in your pay. Something might happen, a blessing might come your way. There's so many factors we're not accounting for from the emotional standpoint of paying off that particular debt. Now, there's times where emotionally it doesn't make any sense whatsoever. And that's where I'll interject to do a little bit of a pushback. Say, hey, I get what you're saying emotionally, like you hate this student loan debt, right? You hate your student loans and you want to pay that off quickly. Your emotion is getting the best of you in this example, because let's look at the math, right? Let's say emotionally the client's like, then I don't care about the cars. I gotta pay off this student loan. I might give a little bit of a pushback on that, right? Divided by 1441.43. So, oh wait, whoa. I messed that one up. Look at that. I screwed that up. I'm gonna have to talk to the client. This is why I love doing math. Look at that. I think because of that payment's so high. Oh wow, I didn't even notice that. Sort of just had that on the back burner. Wow. Look at that. In live action, we might have to adjust what the heck I just said. Let me use the example, because from a cash flow index, it actually makes more sense to pay off student loans over the cars, right? From a cost of money standpoint, makes more sense. Even though, look at that interest rate is so low, okay? Interest rate is so low Now, here's what would not make sense. It would not make sense to move 2.86 to 6.25, especially with that high balance. It's going to take too long to get to the cash flow. So even though the cash flow index number is lower than these two cars, I would still encourage the client to go with the cars instead over this, because of doing velocity banking and the infinite banking concept. If we did not have this line of credit and it was just cash flow per month, making extra payments via cash flow index, we would go credit card, student loan, car. That's kind of how that would play out, right? So the home, just kind of going back to my other example here. Let's say the client wants to just pay off their house. Like, I don't care about these other debts. And I'd say, well, emotionally, I get that, but it's going to take you such a long time to remove that, right? And the argument could still work for the student loan. Say, yes, even though we got that 42.66, it's still going to take a while for you to eliminate this. So where emotion perspective comes into play, in human factor, and also where debt snowball has validity, is that snowball effect, that boost, that early victory, right? We get an early victory here. I can eliminate the car faster than paying off the student loan, even though cost of money over that long haul is higher here, right? So a lot of cool things here, right? Like, you're like, oh wow, a lot of, cool ways we can go about eliminating debts, but still, we're not exactly trying to go for speed with this strategy that I'm presenting to you. Velocity banking and infinite banking combined, its primary goal is not necessarily speed, it's efficiency and converting debt into wealth, right? You're converting the debt balances here by funding a policy with cash flow that you would have spent over here. You're putting it in an asset. That money's going to grow forever, tax-free on a guaranteed basis. And then you have liquidity to pull from to eliminate the debt, park the debt in the policy, and still have your money grow as if you didn't borrow it in the first place. Powerful stuff. Okay, so coming back, let's say we're for sure dialed in eliminating these two debts. My cash flow is going to go up. The 178.80 and the 459. Guaranteed 637.80. Okay. Let's say we want to pay off, I'll go with the higher balance car. Say we want to eliminate that. 22,852.53. Let's pull from the policy. Let's imagine that that's what we were going to do. Minus 15,000. There's 7,852.53 left. That's how much I'm going to chunk out of the home equity line of credit. Watch how this perfectly lays out. So 7,852.53 plus 6,397. The chunk amount is 14,249.53 cents. Okay? And we borrowed out of the policy 15 grand plus 14,249.53. Total chunk was 29,249.53. Is that not well within our 66% range, our chunking range? And it's conservative, and it creates wins immediately. I remove 8.29%, 10.5%, 20%. That's all going into 6.25. 6.25 will get cut in half with this person's cash flow and income. More than cut in half. So it brings their net borrowing costs less than 3% when doing velocity banking. Not bad at all. Total chunk, 29,249.53. We funded 2 assets. That's going to grow forever in their favor. Doing velocity banking super conservatively. Literally takes them a few months to bring that 14 down to 0. They're doing the next chunk within 2 to 3 months. They're doing the next chunk, which is going to be the car, right? So let's play that out, because then you have the 14,249, right? Plus the 6 grand, 14,249 plus 6 grand. Let's just say 6 grand was funding the policy, remember? The other 24,000 is coming from the refund, tax refund, to fund the policy. Okay? So total money coming out of the home equity line of credit is 20,249.53, and then plus that 15 grand, you got 35,249. The true chunk amount is really 35,249.53, technically speaking. Okay, it's just not happening all at once. That 6K is going to come out 2 to 3 months from now, right? The 14,249, that person can do, this client can do that today, right? When they get access to their home equity line of credit, which I think they already do, they can pay off the credit card, and pay $7,852.53 toward their car now, while waiting to fund their policy, the 2 policies, $30K. Make sense? Comment below if that's good. If you're like, I follow you, right? If you're not following, let me know, right? And then let me know where I need to go back, where what you might have missed. So look at this. We got $637.80, and I'm not going to count the $441.88 yet because the car didn't get paid off. So I'll just show what the balance goes down to. $22,852.53 minus $7,852.53. 15 grand, right? So 15K remains on car. 637.80 plus 396942. Now I'm at 4607.22 times 12 times 66%. 36,489.18. Look how perfect, like how close to our true chunk amount. 35,249.53. I basically, we're factoring in that increase of cash flow. It's accounting for it. We can handle going a little bit above 66% because our new 66% became what that new cash flow is moving forward into 2025. Do you see how that happened? Comment below. So your foundation, always relying on that 2/3 amount to figure out your chunk range in correlation with your credit limit, knowing that, hey, I shouldn't go more than 40,260. Cash flow times 12 is 31. That's like, I really shouldn't go lower than that, right? If I'm trying to get results. And I'm in between that and knowing that when I get cash flow increase, it's going to increase my leverage capacity. Not bad. Pretty cool stuff, right? So now within 2 to 3 months, car gets paid off. When you have a loan on the policy, when we're doing velocity banking and infinite banking together, combined, we're going to leave the loans outstanding and we're just going to cover the interest costs. That interest cost that you pay was already being paid over here on your debts. So it's not new interest. It's going to be lesser interest, right? Let's say that the loan interest rate is 5.5%. 15,000 times 5.5% in a year to hold 15 grand interest, $825. So our cash flow will go down by $68.75. Okay? Minuscule, right? Very small amount. Our focus when we're doing velocity banking, infinite banking combined, our focus is max fund the policy first, borrow under 66% or at 66%, we're paying off debt. In this particular strategy, it's velocity banking, infinite banking combined to pay off debt, to increase cash flow, to position ourselves for real estate investing. We're going to do this until we get to student loans and mortgages, and we might stop. Okay? When we stop, that's when we might direct our attention toward investing in real estate to increase income. Use that increased income to pay off all his debt in one shot over time. Could be one strategy. The second is just continue doing it, maybe up until eliminating the student loans, right? And just being left with the mortgage. That's a possibility as well. So, in this case, velocity banking to max fund our infinite banking, properly structured whole life insurance contract, borrowing no more than 66%. That is being applied toward debt. All of our income and cash flow is going into the HELOC to reduce cost of money. We're going to keep our policy loan outstanding. We're not going to pay it back right away. It doesn't make sense. The cost of money is so cheap. That $825 of interest was already in the car loan at 8.29%. You brought it down to 5.5% over here, but you're only paying a portion of that 8.29. Only a portion, 15 grand, 825. Do you see that? Only a portion of it. The rest got eliminated inside of the HELOC, and we did velocity banking. We want to do velocity banking enough where by the time I reach the anniversary date, year 2 of our policies, that I'll have $30K available in cash flow or some cash flow, some leverage inside of the line of credit. Let's see how that plays out, okay? So I will erase some things here to create some space. I'm going to create so much room for error, space, by simply saying our first chunk amount, as if I was doing it today, is $14,249.53 plus 6 grand. So $20,249.53. You minus income going in, right? And I'm not even going to account for the cash flow increase. $13,030 coming out. So 1 month, $16,280. January. Minus income. Remember, this is super conservative. Let's go 3 months out. February, minus income, 15,000, 8,000, 341.27, March. Let's say March the policy is in place, and I borrowed the 15. I pay off the car in March, right? Not even going to account for the fact that you still made your normal payments of $441.88. See all this like extra parameters I'm doing here? Not even counting for all that. So now, March of 25, I owe $15,000 in my policy. I owe $8,341.27 on my HELOC. Car's done. Let's see what our new cash flow amount is working with. So we're at 396942 plus 637.80 plus 441.88. We're now at $5,049.10 total cash flow. I'm now going to erase some of the things on the board here to create some space for myself. $49.10 times 2/3. No, 5,049 times 12 times 2/3. My new chunk amount is $39,988.87. Okay. Let me clear this up. I'll write it again. We'll have $15K loan, cost of money $825 a year. Let's say the policy anniversary is March. So we do velocity banking for a year until we get to March. And we want to basically continue to pay off debt, right? So look, watch this. March, we paid off one car with the policy, the remaining balance. How much space do I have to make my next chunk? $39,988.87 minus balance owed, $8,341.27. I got $31,647.60 of space. What could I do? I could literally eliminate the car and also a large portion of the taxes. So $31,647.60 minus, again, I'll use that balance, $18,951.70. It'll be less because you're still making $352, January, February, March, right? So the balance is going to be less, probably $18,000. Okay, so I'm just going to minus off of that, create all this room for error, $18,951.70. Oh, look at that. I still have enough space to wipe out the taxes. So March, by the end of March, going into April, we pay off cars plus taxes. Look at that. So it'll be $8,341.27 plus $12,500 plus $18,951.70. So I'll owe, going into April, $39,792.97. And I get another $352 cash flow gain. $5,049.10 plus $352.47. We're at $5,401.57. Look at that. Powerful, right? Let's do velocity banking. by the end of April. 39. Hold on, let's do 17,000. Let me see what my cost of living is now. Minus 5401.57. So now my expenses went down to 11,598.43. Do you see how we are reducing cost of living, reducing cost of money on a daily basis? We're not trying to change lifestyles. We're not trying to increase cost of living because you remove something and now we're going to give that money and go spend it, right? And look at how I haven't even implemented the 0% credit card yet, or the cashback or points. Because for me, it's a build. When I'm working with the client, it's a build, right? We build on the strategy. If you try to do all these things at once, even for me, it's a lot to manage. So what I like to do is get the core things going. Do we have our main debt tool? Wonderful. Do we have our policies in place? Wonderful. We know how much to borrow. We know how much to borrow. We understand money in, money out system. That's working great. Cool. We got victories. We have increased cash flow. We're looking real healthy. Now let's go play with a 0% credit card for 24 months, 12 months, 21 months, whatever it is. And we could do a balance transfer and transfer 20, almost 30% of the balance of the student loan into that credit card and then chunk the rest at the HELOC. Could do something like that. I mean, there's so much that we could play with to increase more efficiency along the way. I just saw a comment from Mr. Billy. It says, where did the initial 5,049 come from? So that was us paying off the different debts. So remember, we started out cash flow at $3,969.42, and then we paid off $178.80. We paid off $459. We paid off $441.88 plus pre-existing cash flow $3,969.42. See how I got that? $5,049.10. And then we paid off $352.47 end of March 2025. So now my new cash flow is $5,401.57. My new expense number went from 13 down to 11.5. Now let's do velocity banking. See how long it takes us to pay down this 39 before the anniversary date comes up. Because we need to have 30 grand to fund into the policy plus $825 to cover loan interest. So $39,792.97 minus income. Let's say income stays the same, right? Expenses going out. We're at 34,000, rough estimate. 34,391.40. That's April. $28,989.83 in May. This thing's going to be paid off way before March of 2026. You see that, right? 9, 23, June, $18,186.69. July. August. Boom. So it is very safe to say that by October, paid off. Because again, I created so much like error in here that more than accounts for the interest costs monthly inside of the HELOC and all those other additional things that I did, like factoring in how much we actually chunked. His actual chunk amounts are going to be less than what I'm illustrating here. So it's very safe that the HELOC is paid off by October. This is where having the wisdom and knowledge of Velocity Banking, Infinite Banking, having an accountability partner like myself, a professional, to bounce ideas off when you reach these points. Having the wisdom to know when to stop doing Velocity Banking can save you thousands of dollars. Thousands. Knowing when to stop. So many people that try to do Velocity Banking when they're first starting out, they try to force Velocity Banking, and you end up performing similar results to as if you were to just remove the headache of Velocity Banking altogether and just make extra payments, right? Knowing when to stop Velocity Banking, secure your win, and just say, all right, turn the lights off, leave that room for now. I'm going to keep that HELOC dormant. This is an idea of doing that right here. Let's say October onward, we did no Velocity Banking. We did not accelerate debt. No need. We want to have 30 grand set aside to max fund our policy in the new year. When you get that 30K in there, then we borrow and we go make a move and decide what we would like to do. Okay? So watch this. October, I won't even count October's cash flow. I'll say November, December, January, February, and March. 5 months of cash flow. 5,401.57 times 5 months is $27,007.87. So what will most likely happen is March 2026 max fund policies 30K, right? 3,000, let's say, comes from HELOC. He'll probably have all the cash flow sitting in just a separate savings account, and he's just stacking the cash, no Velocity Banking, paying all his bills on time, running bills through a credit card, getting points, all that lovely things, right? No issue there. We're going to max fund our policy, and we're going to pay $825. So it's 30 grand plus $825, right? And what we could do is a second policy loan for 15 grand. Right as you funded in March of 2026. You do another 15. You could go a little higher because there's going to be more cash value building up in there, right? But be conservative, right? Stick with 15. Let's guesstimate what the balance will be on that student loan. Let's say he's like, you know what, Denzel, I'd like to do Velocity Banking, Infinite Banking to remove that student loan, and then I'll stop removing debt altogether. And then I'll start focusing fully on real estate to increase that income that I have, right? Let's say he really wants to get rid of that student loan debt. Okay. understand we've got, so we got January all the way through January, 12 months, February, March, 14 months of paying $1,441 and 43 cents. So he would have paid on the student loan $20,180.02, right? And let's say, try to guesstimate this a little bit. 62,492.88 times 2.86%. It's 1,787. I'll just double that. Let's say you paid about $3,500 in interest over that 14-month period. So 20,180 minus $3,500. So principal 16,680.02. 62,492.88 minus 16,000. I'll just round it even lower. Say his balance March 2026 is 46,400. Okay, say it's somewhere around there. Cool. So now we figure out how we're going to leverage from where to pay off debt. So we know we'll do at least 15 from the policy. He could go higher, no doubt. Let's just see what 15 looks like. Minus 15K. Now, with this person's kind of income, 6 figures, let's say they acquired a 0% credit card, and let's say they went to Bank of America, okay? Let me share my screen. Let's go look up Bank of America real quick. Bank of America. They have a red credit card right here. See if it shows the details. $200 cash back after you spend $1,000 in the first 90 days. They do a 3% balance transfer fee. Y'all should be able to see that. 0% for 15 months. This is not a hard card to get approved for. Let's say he went with that. And let's say he got approved for 30 grand. All right, let's try that. So 30K, 0%, BOA, 15 months, 0 interest. 30K times 2/3, 19,800. Say we did that. Times 3%. Balance on the credit card, total, 20,394. We got 46,400 minus 15,000 minus 19,800. The balance goes down to 11,600. right? No velocity banking, because mind you, 12 months out, that rate went up to, let's say, 8%. So it's not going to be efficient to use 8% to pay off 2.86. It's not going to make sense. So again, no velocity, 2 months of cash flow or less, and the student loan is paid off, right? So 11/6, we're in March, we could say April, May, paid off, right? So now you've got a $20,394 balance on a 0% credit card for 15 months. $20,394, and they charge 1% of the balance. So your monthly payment's going to be $203.94. Now you owe $30K total on the policy. Say you're at 5.5%. Where's that interest coming from? 2.85. I was going to pay it anyway. 2.86, right? I'm already paying that interest, so boom, that's gone. Not new interest, interest I was already paying. And because that money is now sitting in a guaranteed product, you're earning interest even though you paid interest. So your total cost of interest internally in the policy goes down. Because what you paid, you also receive dividends that same year. Less than your cost of interest. But because the cost of interest was already over here, it's not new interest that's being paid. It's already part of your cost of money. It just got reduced. We reduced cost of living. Cash flow just went up. So now we're at, look at this. $5,401.57 plus $1,441.43. They now have $6,843 come May 2026. The HELOC is at 0, nothing owed. That's a big fat emergency fund line of credit available to them right there. They don't have to use. That could now be repurposed. Their HELOC can be repurposed for investing in real estate come May of 2026 or sooner. Their policy, they owe 30 grand on that. And they owe 20,394 on their credit card. What should I do now? Okay. Very simply, no velocity. Have the wisdom, know when to turn it off. Cost of money is too high now on the HELOC. So we're going to park that reserve. And now we're simply going to save $30,000. That's the first play. Save 30K plus 1650 first. How long does it take me to do that? 30,000 plus 1650 divided by cash flow, 6,843. Takes me 4.6 months. I'll round up. So we'll say June, July, August, September, October. October 26, he'll have 31,650 in a high yield savings earning 3 to 4% or higher, tucked away. He's not going to touch that money. Okay. Now we got November, December, January, February, March. 5 months. Again, times 6843. That's 34,215 minus the 30K loan. We'll go ahead and pay off the 30K loan. Okay? So he'll pay off the 30K loan, right? That's done. All we're left with is what? The Bank of America card, right? The Bank of America card got established in March of 2026. So you got March 2027 is 12 months, April, May, June. So June 2027, what's my balance? I don't like the way I wrote that, so let's do that again. March 2027, 15 payments of $203.94. It's $3,059, so I'll round down. 3,000, 20,000, 394 minus 3,000 bucks. I'll owe 17,394 in June of 2027 when the Bank of America card expires. Let's say that was the card that he got. And we could take a loan for 17,394, stick it in the policy, and pay that off faster than if you would have left the balance in the credit card, because that is going to be at 28%, 29%. So we definitely want to take that balance out of there, right? And we have options. We can stick it in the HELOC. Does that make sense? 8% versus 5.5% loan over here. So that's easy. Just put it inside the policy, right? Be done with it. Okay. So now you got a policy loan for $17,394. Policy loan. And you max funded the policy in 2027, right? March. Max funded it. Okay. Look at you. Wow. Do you feel good? I feel good. How do you feel? Is that a lot? That was a lot. That was intense. There's a lot of moving parts here, but I showed you every single detail. It accounts room for error. We had multiple emergency fund vehicles and access points that we could tap into if and when life happens. We're able to solve for that. Pretty powerful. I know wife's going to be on board with this because I'm showing them guaranteed way to recover cash flow, guaranteed way to grow your money and convert debt into wealth. All these safety mechanisms in it. They had 7 out of the 8 parameters. By 2027 or sooner, they could be investing in real estate fully using the home equity line of credit and or the policy, right? With $6,843 in cash flow per month, it's very doable for them to continue max funding $30K a year, $30K a year, $30K a year. In fact, I would encourage them to now get policies on the kids, right? They have 2 kids. So now that we got mom and dad insured, let's go put life insurance on the other 2 children. So you're basically increasing your savings dollars from cash flow, right? Let's look at the ratio. At $6,843 times 12 is $82,000 times 2/3 is $54,196 minus 30 grand. They got safely about 24 grand to work with to either fund another policy on themselves, or do like, 2K, 2K or 4K, 4K on each of the kids, right? And then the bulk of their cash flow is being put toward real estate, where maybe they're leveraging the HELOC. They can get an increase on the HELOC to invest in real estate, create the income that they desire over the next 5 to 10 years, and retire early, right? 44 years old is the client. Now, by 2027, they're 47 years old, right? And if they took the next 5 to 10 years or less, by 57, it's 2037. 5 to 10 years of just investing in real estate. All their debts are gone except for the mortgage. That's all that remains. They can manage that fixed expense. Doesn't make sense for them to pay that off from a cash flow perspective, right? They can create way more wealth by investing in real estate over accelerating their mortgage. They now have mastery over their finances, over the velocity banking concept, infinite banking, doing it for multiple years if we're in 2027 and beyond. So they have a nice, healthy flow. And let's say that they're able to create $17,000 a month between age 47 and 57. I mean, that is not bad. 17 grand a month passive income in real estate while still working, right? He likes what he does. He doesn't not like it. He likes what he does. It's good money. Very blessed. So that income's only going to rise over time. I mean, there's a world where he could simply allocate an extra $1,000 to their mortgage, an extra $1,500 if they really wanted to accelerate it, have it paid off by 2037 or sooner, right? There's a world where you can do that, or they can just simply put it all towards increasing income. And then once they've created enough wealth to just write a check, pay the house off in full, they can do that too. They've completely opened their world up to options, possibilities, things like that. So I'm going to look and see if there's any questions I might have missed. All right, just kind of going through these comments. Ending on a great note. Yep, I'm excited, man. Like this client and many of my clients, if you're not someone that works with me one-to-one, I have my one-to-one coaching program, lifetime. I do things like this. We map the numbers out on the board together, record it, give it to you, and then I'll make videos like this over time, keeping your name and all your information anonymous, right? My one-to-one coaching program is closing tonight, midnight. So if you'd like to take advantage of that, you just go directly to my website and you can enroll in that. Only invest in my coaching if you are prepared, you've done your due diligence on me, you're ready to build a relationship with me long term. It's a lifelong program. It's lifetime access, unlimited coaching, unlimited access, all my courses, everything I've ever created, everything that I do and offer, I give to you, right? That's the kind of relationship that we would be building together. So you got to be serious to want to do that. Talk to your spouse, make sure she is on board, or vice versa, make sure he is on board, that we're going to be a team, right? Like I'm literally your quarterback. We're going to build your financial dream team together. Create legacy, create wealth, create compounding effects. All right. Happy New Year, everyone. God bless you all. Thank you for your time. So greetings to all. Wishing, blessed New Year. Cool. Hello, Evelyn. We got a lot of lifetime clients here. So Prince, lifetime client. Anthony, lifetime client. Adrian, remind me, I think lifetime client. Minor Ramos, lifetime client. Cameron, I know I've seen that name quite a bit. LaShawn, lifetime client. Right, like we're in it, right? Been doing velocity banking for a few years now and IBC for almost 2 years. Asked Reddit how to incorporate both. The backlash was intense. so was left to figure it out myself. Knew it could work, and it does. Yeah, like it's one of those debated topics, right? So just know that on this channel, we just run the numbers. Like we're just playing it out in real time. Look at how we put this whole thing together and created all these parameters in place to successfully implement it. Okay, been doing the same, and yes, the backlash was massive. Just got comfortable with IBC this year. I was comparing many different avenues to see what works best for my household. That's the other thing too, is like you can always make tweaks along the way. Spreadsheet I created since then are nauseating, but I feel comfortable knowing I'll be ready for another policy by the end of the year. My inner nerd has been unlocked. Lovely. Until you hit your financial independence number, anything other than your core focus can be a distraction. Once you earn back your time with passive income, it's missed opportunity. Very well said. Very well said. Super number nerd here. I keep the spreadsheet tight and everything can be on an index card since most things are automated. Okay, and that was earlier. Do live in Texas. All right, boom, boom. All right. Jacob, also lifetime client if I'm not mistaken. Those first few wins at the beginning are so important, not only for encouragement, but also to reduce the complexity and number of variables you need to track. Good point. Good point. Albert, how are you? Christina, hello, is raising her hand. If you got a question, go ahead and drop it. Ruben says it's a lot to process. It sure is, all right? This is not for the average beginner getting exposed to velocity banking for the first time, right? You got to have that pregame work completed, those parameters in place for me to have the confidence to educate you on this, right? Even though this is a brand new client, right? I first started working with them December 13th. They met 7 out of the 8 requirements, right? 7 out of 8. The only thing that they didn't have was they don't have all their debts paid off. But part of the strategy removes their debts over time. Notice how we removed everything conservatively pretty much in under 2 years. Not bad, right? From 2025 to 2026 May, we more than doubled cash flow, and then by June 2027, like everything is done, right? And then we just have that 17K that's sitting in the policy. Like that's it. And again, it could be done sooner. Thank you. I own the Velocity Banking subreddit. It's rough out there, but growing. You own the Velocity Banking subreddit. You have to send that to me and check it out. What's the cost, young blood? $3,997 one time, or you can break it up into payments at $375 a month. Okay, so you make that one-time investment, or you do 12 payments of $375 a month. You can roll. Again, lifetime access. Like, one of us have to pass away for the program to end. And here's what happens. If you pass away before me, the program gets extended one generation down, right? Or if I'm dealing with a married person, let's say I'm working with husband passes away, wife takes over, right? I'm one of the very first phone calls that needs to be made if there is a passing away of a husband or spouse that I'm working with. My clients understand this. They know. They elect a beneficiary. When you enroll in my program, I'm going to ask you to select a beneficiary. It's like buying a life insurance policy for your legacy, right? For your financial education and literacy. Like, you're going to have a direct person that if something happens to you, you literally put in your will, you write it down, call Denzel, reach out, number, email, all his information. Reach out, the wife knows, hits me up, or if it's vice versa, I'm dealing with the wife, husband reaches out, wife passes away, right, whichever. And then even after both husband and wife passes away, I let them know that the program also goes down one generation. So your immediate heirs, even if you have 5 kids, right, each of them can benefit from my coaching. one-to-one, or definitely in a group setting when they become of age, right? And I have now been experiencing that 6 years into my career, where it's like I was working with a client, their kid was maybe 17 years old when we first started working together, or like 15. Now they're 20. Now they're 22. Now they're like, making money. They're thinking about buying a car, thinking about getting a policy. So I've been working with some of my clients' kids now that they've become of age, more mature, they're making their own money, they may have moved out, and I'm coaching them for free. So like $3,997 is nothing when you look at the value of what you're doing. And you're honestly taking advantage of a young guy like myself that's still building my business. I'm still figuring things out. Like, I have clients that invested with me back in 2019 for peanuts, right? Like almost nothing. And we've just been able to create so much progress. It's amazing. In my last live stream, I gave some stats in terms of the amount of people that I've had the ability to serve on a one-to-one basis in a group setting. It's awesome. We're having a blast, okay? So, I don't see any other questions. God bless you all. Happy New Year. It's awesome to be married. Let me tell you that. That is another blessing I've been able to experience personally. Getting married. We're locked in, my fiance and I. Shout out to her. My wife, holy crap, right? Got to get used to saying now, right? So it was like 4 days ago I was saying fiance, now I'm saying wife, okay? So shout out to my wife. We're about to have so much gains, right? Biblically speaking, my brother in Christ was telling me this. I got to go find the scriptures. But when you get married, God pours out a blessing for the husband, right? Once two become one, that there's these additional blessings that come with getting married. So there's these perks that exist in the logical world. Supernaturally speaking, there's these other blessings that are going to occur. So it's going to be really cool to see what those look like in 2025. So I'm really excited about that. I just think the level of maturity is going to a whole nother level. And I've already said it in my last live stream that the advanced level of content is going to be increasing. So I've done a lot of beginner foundation framework. We're going to be upping that up, right? Looking at velocity banking to invest, velocity banking to make money, velocity banking and infinite banking combined, right? So the advancement is going to be increasing. You're going to see more case studies like this where you're like, Ruben was like, that's a lot to process. I get it. But there are people that I've been working with for 5-6 years that need to up their game, right? We can't stay with velocity banking and think we're going to achieve financial freedom. That's not going to happen, right? Coming from a professional, you need more. It's just little pieces that we've been putting it all together, and now we're building it up, all right? So I'm going to be encouraging you to step up. I'm going to be challenging you to think beyond what you thought was capable so that you can live your highest potential here on this planet before you graduate Earth, all right? So again, God bless you all. Thank you for your time. Appreciate you all being here. Happy New Year. I look forward to spending some time with you in 2025. I'll be going live probably like the first week, okay? Again, coaching program is closing, right? Let me just drop the link. I'm gonna close at midnight because I believe in quality, right? First, I'm a big quality guy, so I only take on a few one-to-one clients per year, and I've been doing this the last like 4 years, where I close the program and then I open it probably like 3 to 4 months into the new year. Gives me time to tweak, make changes, make improvements, figure out ways to be more efficient, figure out ways to get better, master my craft, all that. So that's the link right there for the one-to-one. That's going to take you to the one payment option. If you want to do monthly payments, you just email me directly. You reach out, right? And I'll send you that direct link. And if you're someone that has done business with me in the past, you've spent some kind of money with me in the past, I apply that as a discount off the program that's already super low compared to the value that you're getting, okay? So it's just like a ridiculous offer that is really meant for people that have been doing the work, been doing the pregame. You've done your due diligence on me. You're prepared. You're ready to go. Okay? There's no guessing here. There's no hoping. Like, you're assured. You're like, this is my guy. And we're about to go on a 10-year plus run and have some fun. All right? God bless you again. Talk again soon in the new year. Bye, everyone.